Did you know you can lose money through property even if your property goes up in value? Let me explain. Hi, my name's Nero from Investment Rise, and in this video I want to talk to you about the opportunity cost that you end up paying when you buy a property not necessarily in the wrong area, but at the wrong time. Let's look at, for example, someone who I spoke to recently. Now, they bought a property in Sydney back in 2017. Now, you may know that the Sydney market hit its peak in about July 2017, and the prices have dropped since then, and Melbourne hit its peak in about November 2017, okay? So they bought early 2017, they paid $1.2 million for their property, all right? They had an 80% loan, so their loan was $960,000. Great. Now, fast forward to 2019 when they first reached out to me, and their property was now worth $1.05 million. So it had dropped $150,000, okay? But the reason why they reached out to me is they thought they could still invest and buy property in a growing market to offset this loss, because they thought they had equity in the property because their property is worth $1.05 million, despite the fact it had dropped, but their loan was only $960,000. Yet when it comes to working out equity, what banks do is they take the value of your home, they multiply it by 80%, and then they subtract what you owe. And unfortunately, in this person's situation, 80% of $1.05 million is less than his loan, which means he actually has zero equity available in his property. Okay, so then he was like, well, what do we do now, right? And so what I want to do is walk you through his scenario, because he's not in a situation where he's going to sell and realize $150,000 loss, okay? So the property has dropped quite significantly from 2017 to 2019, all right? Now, thankfully in 2019, we have had some interest rate drops that has stopped prices dropping as rapidly as they were over the last couple of years. But the thing is that it depends on which suburb you are looking to buy in now for future performance. In this particular person's suburb, the best case scenario is that based on all the predictions out there, his suburb will rise in value by about 5% over the next 3 years, okay? So let's just say for argument's sake, his property has dropped what? About 10% or so, maybe a bit more, maybe about 12%. He's dropped, okay? Now, let's just say his property rises in value by 5% over the next 3 years. So he's up 5%, which means minus 12 plus 5, just for the case of this exercise, means that he's still negative 7%. But he's lost 2 years here, and this is 3 years afterwards. So we're now into 2022. Okay, which means that you can see here just in the camera that over 5 years, he's still down 7%. Now let's just assume that then the property does eventually go back to the price that he paid for it, or maybe take another 3 years, which means he's at now 2025. Okay, so look at this. He's bought in 2017. His property then, in this scenario, won't get back to the price that he paid for it in 2025, and then maybe by about 2027, he has made a capital gain. All right. So yes, so property investing is a long-term gain, but here's a scenario: for 8 years, he wouldn't have been able to really touch any equity in his home really for 10 years until his property rose in value, which meant that not only had he lost value on that property, but the opportunity cost. He couldn't use any of the equity that he wants to use in order to buy somewhere else. All right, and that was this person's real dilemma, because he felt like he'd wanted to buy this property, he'd bought it off someone, and his aim was to then use the equity in this property to then buy future investment property and build up a portfolio so he could retire in 10 years. Yet when we went through the projections, he was stunned to see that really in 10 years' time, he might have got some equity gain on his property because of when he bought it. Now, he bought in a good area. Okay. However, it's just that he bought at the wrong time. And this is one of the key things that we need to understand, is that when you're buying in an area, when you're buying investment property, when you buy matters. All right. And for those people who bought in around these areas in 2017, it is going to take them many years before they get some equity increase before they can tap into the equity and use it to build their portfolio. Right? At the same time though, he's also seeing his rents dropping on his investment property as well, which means it's making it harder for him to cash flow. But because the property has dropped in value, even though other lenders are giving him better interest rates, he can't refinance because the value is too low. He's in a real pickle. Now, of course, come 2025, 2027, his property would have risen in value. Say he holds again for until 2032. 15 years later, his property's worth significantly more than he bought. He may look like a hero on paper. However, the journey has been so painful because he would have bought at the wrong time. He's missed out on the opportunity to buy other properties. And mind you, his goal was to create wealth over the next 10 years. All right, and he would have failed to achieve that goal because he bought not in a bad area, but he bought it in a good area, but at a bad time. Hey, thanks so much for watching. If you found this video valuable and you're thinking you might like my help to help you find an investment property, then head on over to nerocall.com to discover our unique 5-step process that's helped my private client group purchase now well over $66.2 million worth of property. And then if you like what you see, you can book in for a free half-hour phone consult with me personally. Either way, thanks again for watching.